Well, let's move on to another transaction here that may have some insights that our audience can learn from.
Yeah, and without being a spoiler alert, the lesson is know the decision makers, and everyone knows that, but we don't always follow that knowledge. And so in this situation, great husband and wife business started when they're very young, just the two of them in the trenches, out of their house, and the business kind of grew, and they were removing asbestos and other hazardous materials from private, commercial, and government facilities throughout the Southeast, and had a lot of contracts to do that, and their business really started growing nicely. They weren't super motivated to sell, but also felt like it'd be great to kind of solidify their retirement at a young age and continue working maybe for somebody that bought their business. And so we were looking for some people to come in.
Just out of curiosity here,
sorry.
Jay, with the situation with COVID, was this a negative or positive? Did everything sort of stop, or
no? It
what
was
happened in this type of business?
Yeah, because the government part of those really went up. So some of the schools and government buildings, as people were sent home, it kind of escalated the demand to get in there and kind of get through. And
that's what I was thinking.
Yeah,
when the schools are empty and you have to do this,
Right.
what a better time to do some of this work and get caught up.
That's right. Exactly. So things were good for this company. Had two phenomenal corporate execs that were kind of a search fund. So they had their own money, but they were coming in with.
Why don't you define a search fund for our
Well,
audience?
yeah. So the funny word is a fundless peg. So you got the private equity groups that have a committed fund. Say $500 million or $1 billion.
And PEG is private equity group.
Private equity group, and they have to deploy those funds within a certain time period, or they have to give that money back to the investors. So they're motivated to deploy that money in a certain time period. Most of our transactions being lower middle market, again, we're not doing the $100 million and $1 billion deals, so they don't want to buy. If they have a $500 million fund, they don't want to buy 50 $10 million companies, or even $20 million companies. They want to buy 5 or 10 $7, $50, $100 million companies. So right below that there's search funds, which are basically some wealthy individuals that don't have a committed group of money they have to deploy. So some people call those search funds, some people call them fundless pegs. And the reality is they've got to identify the business, and then they go find the money. With a committed fund, they already have the money. They have to go find the business to deploy the money. So this is find the business, and then the backers will look at this individual company and then determine if they want to invest in it or back these corporate execs.
And that's important for business owners in the audience to really get their head around, is that some private equity groups do have funds ready to deploy. And as you said, there are some here that you called fundless. They identify the deal first, and you really need to know what kind of fund you're dealing with at that point in time, because it is crucial on the time it takes to close a deal, and assumptions can be made that the money is there and may not be. Is that right?
Yes, and in this situation, again, it was innocent. It wasn't malicious that these two individuals, that they had someone that was really interested in backing them. But when COVID hit, the backer said, hey, we need to shore up our current investments to make sure they're not undercapitalized, or if there's a capital call to get through this time period and we're not making any additional investments. So at the end of the day, even though we did do our homework, we really didn't know that the two execs weren't the decision makers. It was someone else that actually was going to say yes or no at the end of the day. The good news is, since they were very well qualified financially and background, is we were able to find just kind of more of a traditional lender that was willing to look at the deal, and with their backgrounds really loved what they're bringing to the table, and they were able to kind of step in as a senior lender. And now the two corporate execs, they were the decision makers now, because the lender was at their discretion, whereas the first time around.
So it went from an equity investment to a borrower lender environment, right?
Right. Yeah. And we just should have, had that option earlier, because time for us is everything, and time is our enemy in this industry. And fortunately, the seller was very calm this whole time period, never got rattled, and he and his wife loved the two buyers, and were patient with them as they kind of reorganized their lending options. And so it ended up being a great transaction. Sellers were happy, buyers were happy, but we
So
did
in a transaction
lost
like
3 months.
this, Jay, was it that since the deal kind of evolved and changed, did the seller actually have to carry back additional money that he hadn't
Great
planned on
question.
carrying back?
So in the new structure, there was a little bit increase in seller note. But the buyers were great, because realizing there was a little bit less cash at closing, they agreed that once the debt to the senior lender was paid, and they were paid a fair kind of management salary, that any of the profits would be split to pay down that increase in note quicker than the original amortization. So ended up being a nice little kind of, I call it mailbox money for the seller, and an increased pay down schedule based on the performance of the company, which the seller respect, to say, listen, so if we do well, we're going to pay this down quicker. If things just kind of stay status quo, then you need to be prepared to wait the full amortization on the increase in the seller note. And so again, they had a great relationship. They're able to talk through that, and communication is critical and things like that. Same thing with the deal fatigue that could have set in. One of the parties could have said, you know what, I've had enough. I'm done with this. I'm just going to take my ball and go home. But fortunately, they had a good communication, and they're committed to each other, and we were able to get it closed.
Was the plan of the new buyers that were coming in, were they planning on scaling up the business and growing, where the existing owners were kind of, content and, just doing business as it came in?
I think that the sellers did want to grow, but they're probably not as aggressively as the new owners. And the seller would like the business and like the idea of staying on, and has continued to stay on, kind of running the business for the buyers. But the good news is, again, they're now growing on the buyers, financial wherewithal. So the seller has gotten rid of all their personal guarantees, and don't have the risk exposure. And now they put millions into their, investments to already, at a young age, solidify their retirement. They want to continue working, but they could retire now, and I mean, they're in their mid 30s, I think, late 30s at the most. I didn't really ask the question. They look very young, and they got young kids, so I was kind of guessing on that. But it was a great move for them to do that at this point.
And they had long-term equity in the company, or did they roll out after a few
They
years?
rolled out, so it wasn't a recapitalization. They just, the only thing they're holding back was that increase in seller note, which ended up being about 15% of the total deal. So I mean, it was a big number. But like I said, we've got the plan in place to try for the buyers to pay that down quicker, based on the growth and the success of the
I
business.
know we have confidentiality issues here, but was it a 7 or 8 figure number?
Well, the total purchase price was an 8-figure, and the seller note was a 7-figure.
Okay, so that's significant. So
It is. Yeah.
well, I guess the big takeaway then, if we're going to recap this, I guess the big takeaway is know your decision makers.
That's
Even
right.
though you think you may know them, you really have to know who is going to make the final decision. And in this case, you thought you knew who was making the decision, but at the end of the day, when COVID hit, there were other people behind the curtain that were pulling the strings, and which is a valid reason,
Right.
they wanted to make sure that their portfolio companies were taken care of, and that they had adequate capital to keep those companies well supplied with funding, that they became cautious and closed down all new deals, which is a normal kind of conservative outlook on how to manage a portfolio.
They're
But that
fiscally
left,
responsible. They're
they're
fiscally
so
responsible. So absolutely. Yeah. Made sense.
so
We had no beef with that, understood it, respected it. Just wish we would have known that 3 months earlier.
and so you really need to ask those questions up front and make sure you know who you're
Yeah.
dealing with and who the real decision makers are. So the takeaway, know the decision makers, is always good advice for anyone that is looking to position in their company for sale. Well, Jay, why don't we kind of move on to another transaction here? that may have closed or may not have closed. Why don't you share something that may be a little bit out of the ordinary?
Yeah, one of the unique transactions that we've done, because we don't do a lot with retail unless it's really high volume, and this was another anomaly where, in a 5,000 or 6,000 square foot facility, it was probably the most profitable business I've ever heard of. 7 figures of cash flow, and just a really kind of an institution for where they're located and what they did, and very few I've ever seen around the country.
Retail business?
Retail. I would
What
call
type?
it a gift shop, but that doesn't do it justice. And without breaching confidentiality, you can just think of just when you have a birthday, a graduation, any kind of thing of celebration, or just gifts in general. It was one of those, you can find anything and everything that's unique that you wouldn't find in a
And
big
how
box.
large of a location was it?
I think it was like less than 6,000 square feet. I mean, it was not a large. It just was. It was just one of those neat little. Everyone had to go visit it. Whether you
It sounds like it had been there forever and a day.
Yeah, yeah, been there
They're
for,
long.
25 years. Two partners that ran it, wildly successful. Had the perfect buyer who's his wife was already in business for himself. He knew exactly, growing up in the area, he knew it, and was just, when it came on the market, it's like, man, that's just an institute. I mean, everyone knows of this little secret, high volume knick-knack gift shop. I don't know how to describe it other than that, but it doesn't do it justice. It was just really a neat business.
Well, I guess the bottom line is that the cash flow was gargantuan. It was a strong cash flow business with 7, 8 figures in sales, right?
Yes. Yeah. It was very neat. Husband and wife team, they were buying it, got along great with the two business owners, their business partners, and everything's going very well. They did not own the facility. They preferred just to lease it.
Why, in a situation like that, normally a buyer would, consider acquiring their facility. What was the thinking? Did you get any insight to what their thinking was on not acquiring the building?
Yeah, no, it's funny because, a lot of different businesses have different mentalities, and some people just don't like the thoughts of brick and mortar, because to them that just doesn't feel like it's very liquid. And if they needed to move or relocate, they're not tied to owning the bricks and mortar. So these two sellers never really thought about buying the location they're in. Just it was a reasonable rent. They had a great relationship with the landlord for the 25 years, and
So are you aware it was kind of like a 5-year lease that was just renewed again and again? And
yeah,
did you know the landlord personally, or was it just a large?
Since they've been together so long, just they just do 5-year increments, and 9 days before their 5-year was up, they'd go and sit down and talk and do another 5-year extension. And this situation, my memory serves me correct, it's about 3 years in, so it's about 2 years left on the existing lease. And the lesson is, people get funny when it comes to money. And so this is in the middle of the real estate boom, and landlords are getting really proud of their facility. The seller's like, not going to be a problem. We'll get a brand new lease. The buyer's like, I'd really like to get a 5-year lease with 2 5-year options. Won't be a problem. We've paid on time every month for 25 consecutive years. It won't be a problem. So famous last words, right? So they're paying below market rent, $10,000 a month for, over 5,000 square feet. So talk about, very reasonable $18, $20 square foot for, good location. And the landlord said, well, that was our deal because we were friends and all that, but I want to double rent. So literally wanted to increase twice. So from $120,000 a year to $240,000 a year. And even though it's a 7-figure cash flow, if you're eating into that cash flow, 7-8%, and you're paying a multiple of cash flow to buy the business, then the buyer all of a sudden got a little bit of heartburn on, hey, this, I'm not exactly gonna cash flow the same amount of money that you were. So that obviously,
you paint yourself into a corner. I mean, the landlord holds all the cards in these situations, and obviously you have the option to move, I guess, but it's an institution. It's been there for 25 years. That's not really much of an option, I guess.
right? Yeah, location was critical, right? I mean, it was a destination that people went to, and so you didn't want to, even though a destination, sometimes you can move those, you just wouldn't want to disrupt. There's a lot of cost to moving, and setting back up, upfit a new location, all those things. It just didn't make sense, especially for a new owner. I mean, if people are looking to sell, that's one thing I tell people. If well, someone needs to, I'm outgrowing my facility, I'll probably have to move in the next 6 to 9 months. We always say, move now, because the burden of learning and transitioning into your shoes as a new owner, they don't want to think about then having to, in addition to that, move the business. So if you're thinking about selling and you're about to outgrow your current location, it's much better to go ahead and do that, so that burden isn't placed on the buyer, because it's going to scare most buyers.
Yeah, so in this situation, I guess the landlord holding all the cards, I guess he can become very difficult and blow the deal up.
Yes.
So we have doubling in rent here. I'm real curious, you said, which I think is really apropos, friendship aside, people get funny with money, and when it comes to money. And so how did this unfold?
As I say, this is the biggest kind of increase that we've ever seen. We've seen many landlords, kind of the joke we say to the sellers is like, this is the thanks you get for paying, rent on time for 10, 15, 20, 25 years, is now we're going to, kind of screw you at the end, or potentially screw a life-changing transaction for you. But it didn't. Luckily, the landlord came down a little bit in their senses, had a little bit of emotional tug from the sellers, and agreed to only increase it 80,000 of the 120. We agreed to kind of offset the first year or half the first year increase. The sellers agreed to a small price concession to basically give the buyer a full 12 months of breathing room to get in there and get acclimated and try to help, increase the sales to bridge some of that increase in the rent. And it worked out. The good news is it worked out. The buyer's doing great, and is one of those people that probably open up another location because it's such a neat thing in another major market down the road. But
did they, in this particular case, did they draft an entirely new lease signed by the new owners, and there was no obligation by the seller at this point in time?
Yeah, great point. Yeah, a lot of times with assignments, as you know, that the landlord won't release the original tenant. They'll assign it and add to it the buyers. In this situation, we got a brand new lease, brand new 5-year lease instead of assuming the last 2 years, and then kind of fix that. Even though it's a big increase, they fixed that for the first, I think, 3 or 4 years of the 5, and then had a couple of options on top of that.
Well, for a seller, that's the consideration, because even though the business is great, you don't know these new buyers, and 2 years in and you're still obligated on the lease, you never know what would happen. Things can go wrong in the economy and a lot of other things. So that's a major consideration when he can walk away and have an entirely new lease and no obligations when he had 2 years left on his lease. So that's a major consideration, I would think.
Yes, absolutely. Absolutely.
Well, people get funny when it comes to money. So that's the big takeaway here. So you just don't make those assumptions that good old buddies and longtime friends, when it comes to money, sometimes those relationships get clouded, don't they?
It's all forgotten, right?
Well, all right. So why don't we kind of move in and kind of wrap up our discussion here with a fourth and final transaction you've been involved in.
Yeah.
Maybe one that you kind of hit it over the fence. Why don't we
talk
a little bit about something that kind of went really well and maybe spectacularly well?
Yeah. So, I feel at the end of each transaction, very rarely do I feel like a buyer and seller can't look us in the eyes and tell us that, we didn't earn 100% of our fee, because there's always just numerous, again, if there's 150 checklist items and we're overseeing all those, that, we earn our commission every single time, and every deal is unique and every deal has its own challenges. So there's nothing easy about our industry, but every once in a while, the things will line up perfectly. And in this situation, it was a father-son team, started, 30 years ago, the father out of nothing, and grew this empire, one of the largest, and it's in the, subcontract services industry in the Carolinas, one of the largest of its kind. And we didn't find any local traffic, and it was one of those in between when you're talking about that 15 to 20.
The reason you didn't find any local interest, was it because of the size, you think, that they
well, so we try to go strategic and some smaller private equities, because in that $15 to $25 million range, and we didn't. And then someone out of the West Coast found us, and they had a footprint and a platform in this industry, looking to expand. They love the Southeast, especially the Carolinas, because of the growth and all the positive things that are happening here. And it was perfect. They loved that the father wanted to retire, the son wanted to stay on and was willing to retain some of the equity because they're going to do a recapitalization where they own the majority, but the selling, this time just the son, was going to retain some of the equity in the new company that's being formed. And so much so that they're detailed in their due diligence and the quality of earnings and all that, but they just did everything they said they're going to do. Not just the letter of the law, but when they said they're going to be done with quality of earnings, they were done with quality of earnings. When they said they're going to start.
That's kind of unusual, from my experience. And, we hear a lot of transactional stories here on the podcast of construction-oriented companies. And it's generally the rule that, contractors tend to kind of shoot from the hip, and they don't have all of their documentation, although they may be great operators. When it comes to back end type of stuff, they tend to be lacking a little bit here. So this is kind of a flip of the coin. On the other side, it sounds like this father-son team been around for, would you say, over 30 years?
Yes,
Close
and
to 30 years?
It was, Martha, one of the first times that we had the sellers in here to meet the buying group. The father was early, and I saw him. I said, "Hey, I like that. Early's on time is late." And he came over the top and said, "Late is unacceptable." So I think, in a world that's renowned for, I'll be there between 8 and 2, and they may show up between 8 and 2, and they may not even show up. Here's a company that built its reputation on showing up on time, and so that was really important when the culture they created.
Kind of inbred in the culture of the company, starting at the top, I guess.
That's right. And so the buyer group saw that, they respect that, they like that. And I think they kind of a similar approach. And so when they said, "Hey, we're gonna be done with this," and they met that, that was that much more impressive to the sellers. And then the key gentleman at the private equity on the West Coast even came out here, just flew out here just to see them kind of halfway through. When we're done with the due diligence for the financial side, I started drafting closing documents just to sit down and look them eye to eye and say, "Hey, we're on track. I have no concerns. Everything's a go." And that's just another thing that to me is, doesn't happen very often, especially if it's driving distance, that's one thing, but to fly from the West Coast into Charlotte and sit down just to spend 2 hours with a feel good meeting, spoke volumes for who was buying them. And so that relationship and the bond and the commitment they had to each other to close for us a good sized transaction in a close window, and everything just the stars align. So at the end of the thing, that's every once in a while in merger acquisitions, the stars will align, or if it's a perfect buyer, perfect seller, and perfect match, culturally, backgrounds, and what they want to do in the future. This all came together and was a huge win for both sides.
I'm curious, obviously this company had been around a while and it's fairly good size. You said one of the larger in the region there. I'm kind of curious, they obviously had a good management team put together. In situations like this, it seems often that the existing management team may look to acquire the company, maybe through some either private transaction internally where they go out and get financing, or some sort of Eastsop. Was that an option here?
Yeah, absolutely. It's the father, that was his original plan. I think a lot of business owners, their employees become their family, and their perspective is, I want to do something for my family. I want to do something good. And so one of the options, to your point, Marvin, is they look in this employee stock option plan, which my joke about ESOPs is if you own a brewery, it's a great option because everyone that works there loves drinking beer and making beer, and it's just that's my attempt at a joke. But outside of that, I have not seen a lot of business structures where ESOP makes a lot of sense to the seller.
So just for clarification, ESOP, ESOP is Employee Stock Ownership Plan, which is a structure that employees can go out and get financing pay the owner carries some,
Well, it's
and the
expensive to
benefit,
set up. Yeah, expensive to set up, expensive to maintain. The benefits to the employees is a lot of times they're paying out the owner from the profits of the company. But for me, a lot of the businesses we meet, they're so giving and thoughtful of their employees. I tell them like, hey, listen, unfortunately, this is the one time in your life we need to be a little bit selfish. And the company paying you out over time with the profits of your company may work, but from our experience, that third party buyer where they're getting their own financing, they're signing on for the debt and they're giving you mostly cash at closing. Maybe there's a seller note, there's an earnout, but they're solidifying your retirement with real cash at closing. That sometimes is a better fit for the employees, where if there's not one true, decision maker and there's two or three of them,
yeah,
in business structures, I feel like, you don't want a bunch of Indians, right? You need or chiefs, you need a bunch of Indians, you need a bunch of workers. One person's in charge. And when someone comes in and buys it, the buying group's in charge. When you kind of not give, but sell to an Eastsop, for me, I don't feel like it's always advantageous to the seller. They need to be selfish one time in their life. If they want to give some of the proceeds to the employees down the road, not at cash at closing, because the buyers don't like that, but 6, 12, 18 months down the road to stick around with the new owner. I love those type things, but I'm not a big fan of Eassops unless you own a brewery.
Point well taken. Well, so here we have a situation where, kind of unusual, I guess, for, a contractor as a general statement, certainly not globally, I'm sure, because we have exceptions to the rule like this, where you have someone that, did everything, had things lined up, as you said, kind of demonstrated the culture of the company when he showed up early to the meetings, and said that the alternative was really unacceptable. And so that's obviously a core belief on how he ran his business. And as you went through the due diligence process, which is, again, somewhat unusual because there's always issues in due diligence. And what you're telling me in this situation is that there were very few, if any, real problems in due diligence because they just performed and did what they said they were going to do, primarily, probably, because things were all so organized. Is that a fair statement to make?
It is a fair statement. They're well organized. And again, the communication between the buyer and seller was really well. They're committed to each other, they liked each other, they respected each other. So, managing expectations is a big part of what we do. But when the buyer and seller are communicating well and they're dictating to the accountants and the attorneys as business owners and making business decisions how things should go, it normally works out a little bit better than when an accountant or attorney is dictating to the buyer and seller how things should go. They're in control, they're communicating well, they're doing the deal, and they're just getting their people to put in the details behind what they decide on.
And I would imagine in this particular situation, the buyer had a lot of confidence in what was being presented to him because it was complete. Uh, the, Probably not a whole lot of skeletons in the closet. And the feeling in a negotiation like this is that what you see is what you get. And you're not doubting the numbers because they're incomplete. You're not doubting the documentation because it's not all there, and you're having to make assumptions on what may or may not be there that holds up the transaction. And I would imagine this is reflected in the multiple. Would that be a fair
It
statement?
would. Absolutely. Absolutely. And, in real estate, people say location, location, location. In our field, it's like disclose, disclose, disclose. Everything's going to come out at some point. So go ahead and disclose it all up front. That way there's no shocks or heartburn down the road. And again, transparency was important to the sellers. And to your point, they didn't have anything to be afraid of. So they're very transparent, disclose everything up front. And so during due diligence, everything lined up well from the buyer's perspective, and it just made things go very smoothly.
I like that. I haven't heard that before, so I'm going to steal that from you, Jay.
Not a
Disclose,
problem.
disclose, disclose. When things do line up, and they line up for a reason, that doesn't happen by magic. The stars align for a reason, and that's because they had properly positioned their business for sale. They had management in place, they had their documentation in place, they had everything that a buyer would be looking for. And that was reflected in the multiple. They didn't have to argue, and I would imagine the terms were pretty locked down, and there wasn't any last minute negotiating.
No, and including a big sticking point is a lot of people know in this industry is the net working capital calculation, and we had that up front, so there wasn't a very tight collar around what that number was going to be. So when they're done, there wasn't a lot of back and forth on that number.
Why don't you just, for the benefit, we haven't chatted about that on the podcast recently, about that net working capital.
So in deals that are kind of north of 10 million, if they're below 10 million, a lot of times the buyers bring in their own working capital to the table. Above 10 million, a lot of times it's part of the purchase price. They may increase the purchase price, but they want normal amounts of working capital to be included in the transition. So it's included in the purchase price. And oftentimes, some of the bigger private equity groups will, and they're not malicious about it, they're just trying to do everything they can to get the best deal. They'll put in their letter of intent that net working capital be calculated based on GAAP accounting, and they don't put any metrics in there.
And GAAP accounting is generally accepted accounting principles.
Yep,
so
which no one does below 25, 50. I mean, even $50 million companies, very few people are true GAAP. If you look up the definition of GAAP and then you apply it to net working capital, I mean, obsolete inventory. I mean, just different things you just don't think about in a normal day-to-day operating of a business. And so what we like to see is to make sure that we pin that number up front based on the seller's accounting practices. They're what they've been doing historically, so that there's not an opportunity for the buyer to claw back part of that purchase price. And so those little things can, and oftentimes that one sentence written in the benefit of the buyer can call back 5, 10, 15% of the value of the purchase price. In this situation, they put the normal language in there, but when we changed it to make sure that didn't happen, they're fine with it. So that oftentimes is a big number for us to negotiate through down the road. Once the quality of earnings is done by the buyer, they come back with this. Well, in April it peaked, and we need $5.5 million or whatever the number is, and we address that up front that we're going to do that over a course of 12 months rolling, and the real number is going to be between 3 and 3.5, or whatever the number is. And that oftentimes will save the seller a lot of the ability for the buyer to claw back part of the purchase price.
A lot of technical wording and verbiage in what you just said.
Sorry if I didn't mean to do that.
No, but the bottom line is that if you have your business positioned properly for sale, big issues like this, because there's so many other attractive things about the business, doesn't become a stumbling block where the buyer is really trying to hedge their bet because they have high confidence in everything else in the business. Just did not become a huge stumbling block, which it can in many situations. Well, Jay, this is fabulous. You've shared some unique stories, things that had sort of different twists. Some of these things we've heard before here on the podcast, some of them we haven't. So I really appreciate you taking the time and
thank you,
and talking us through some of these interesting transactions. If people wanted to reach out and get a hold of you, Jay, how would they do that?
Our website is vikingmergers.com. That's V as in Victor, not Viking, but Viking Mergers is plural.com. My email address is just my first name, JAY @vikingmergers.com. And our phone number is 704-676-0940.
All right, that's great. Well, this is Marvin L. Storm at Business Success Stories, and we'll see you on the next episode.